Mm-hmm.
And then like at 8:30, I'll make like an official intro or whatever the case may be. And put on, I'm sure this is on silent. Do not disturb. Okay. So anyways, you're still at the office by the off of US 27, right?
Mm-hmm.
Is
Yep.
How long have you been there?
We moved in 2020. Yeah, 2020 in that one.
What's your whole thought of this whole like? Because you guys can kind of work from anywhere.
Mm-hmm.
Work from home versus work in the office. Like I can't work from home.
I cannot work from home.
Yeah.
I mean, even if my kids aren't there,
Yeah.
it's just hard for me to. I like to have my whole setup.
Yeah.
I've got my double screens. I've got all the things that I need. I've got the space to spread out at my office.
Yeah.
Whereas at home, it's just not the same. And there's laundry and dishes.
Right. There's too many distractions.
All the things to be done. So.
I feel so unproductive when I'm at home.
I know. Some days I have to do it. Like, whatever. Kids are sick and I'm there. I just can never quite get the same amount of work done.
Yeah.
Mm-hmm.
I mean, do you have any issues with like your staff working from home?
No, a lot of them can be productive from there. I have an assistant who lives in Virginia.
Okay.
And she only works from home.
Okay.
100% of the time, but that's just her. She's
some people can do it. Yeah, some people can totally do it. My wife is like she has no problem working from home.
Well, and actually my processor works from home. She was a remote employee when she was hired, and then through COVID, Movement had a big move to go back to the office just in the last quarter.
Yeah.
And we had a lot of people who were like, no, I don't want to do that. But during COVID, we realized how much more that people really can be productive. Some people, some of them. But we were finding before where we would have people leave the office right at 5:00, they're out the door, and because they got to get through traffic and to the gym or all of those things, were staying working longer because they didn't have to do that. So they were putting in more hours. And I think sometimes hours shifted, like they might have taken a gym break in the afternoon and then they come back and they work for a couple hours in the evening. So it was an interesting shift in the workforce, I think.
Yeah. We're seeing that in the just as on my side with regard to commercial buildings. I mean, there's definitely been a pullback for office use. But there's it's like a pendulum.
Right.
There was this everyone work from home, and then there's sort of this pendulum swing that's coming back where people are realizing that some people are good working from home and other people are just not productive working from home. And you have
challenge is it's hard to kind of from a company standpoint, it's hard to identify.
Yeah, you almost have to have some kind of measurable. There has to be something measurable in order for you to be able to identify what that is.
Right.
You know what I mean?
Yeah.
How do you know if someone's being productive? You'd have to have certain things that are being completed and then compared to what?
Well, I know that there are companies that can tell how many keystrokes you make on your computer throughout the day.
Yeah.
They can monitor all that. So there are some where they're like, you were literally not doing anything on your computer for hours today.
But you have to, I feel.
But that's kind of pretty granular.
It is very granular. I mean, and for a small business owner is not going to necessarily be able to afford a service that. They, in terms of identifying what's going to be the most best return on your dollar, that's not usually the best thing.
Nobody really wants to work for a company that's that micromanaging them and watching them so closely, especially if you're working from home.
I think it depends. I mean, I think it probably is an algorithm of how much am I getting paid versus and benefits and versus what I have to deal with. So I think that there's a trade-off for a lot of people. And then there's also finding really good work is tough.
Yeah.
And sometimes you just have to suck it up, and that sucks.
Yep.
So actually, let me close the door real quick, and then I think we'll officially get started.
Sounds good.
Just so we don't have any noise coming in. Oh, I gotta turn the lights on too. Hello. See, this is why sometimes I'll just kind of get things started early on. Oh. go. There we go. All right. So you don't have to worry about cheating.
Feels like a very wide angle camera.
Yeah, don't even worry about the camera. So this is really just a conversation between you and I. So if you want to refer to the camera, feel free to do so.
Okay.
So I just do it at the intro and
and
the outro. That's kind of how I do it. Let me see how my setup is set up here. So I didn't get a chance to test this. So keep this here. All right. So I think we're pretty much. Oh, we still got another 9 minutes. That's okay. I'm gonna go ahead and just get it started, and then whoever joins, they join. So, how you guys doing? My name is Gus. I'm Gus Ortiz. This is the Ortiz Anomaly podcast. I'm here with Jen Micklos from Movement Mortgage. You're like the branch manager, but like it's like a franchise, right? And you're like on the franchise owner.
No, it's actually a retail mortgage lender.
Oh, okay.
Yeah, we're part of the main.
I gotcha.
Movement Mortgage.
That's awesome. That's awesome. So I'm, if you guys don't know, I'm with KW. I'm KW commercial director and a productivity coach. And Jen Micklos is branch manager the right term?
Yep. I'm the branch manager for our area. And
I gotcha.
And still just a loan officer too.
You just a loan officer. You run things. And you don't act like she's super modest. So I want to first kind of get into I know that we were talking about like sort of the office, but like what got you into like mortgage lending in the first place? I mean, nobody goes to school. It's like a real estate.
Now I think some people might go to school
That's
for
true.
it. There are actually programs at universities that for mortgages and for real estate.
Yeah, that's true.
They didn't. I don't think it was there when I was there because I didn't know what a mortgage was. Even after graduating with a degree in finance, I didn't really understand it.
Yeah.
But I kind of got into mortgages the old-fashioned way where you kind of just fall into it.
Yeah.
My mom was playing in a charity golf tournament and had one of the people that she was playing with was a mortgage lender, and he needed somebody to be an assistant for him.
Yeah.
And I had recently graduated with my degree in finance, and she was like, "This is a perfect opportunity. Let me introduce you to my daughter.
Wow,
She's living in Tallahassee, having fun and not doing anything yet.
Yeah.
And maybe I could get her to move home." So it ended up being a perfect opportunity for me.
And for your mom, apparently.
Yes, absolutely.
That's funny.
Yep. So I started working in the business, working for a guy who'd been in business for decades and had a really successful business. And so I got to learn at a really fast pace, instead of, one transaction at a time, it was, dozens at a time. And so I got a really good education, just kind of threw me into the deep end. And
that's cool.
But it was different. It was a whole different world back in 2003 is when I started. So
this has really been like your primary career.
100%.
That's awesome.
There was a time after the mortgage crash that I thought I was going to do something else. I went back to school to get my MBA, and I was like ready to just change course and go into a different direction. Mm-hmm. And then it pulled me back in. Yeah. I ended up right back here. And now I can't imagine anything else. Like I can't imagine any different career. It's been a really great opportunity for me and, having a family and stuff like that.
That's awesome. How many people are on your team now?
We've just added a couple new ones. So let me think. I think I've got 5 loan officers and myself.
Cool. And then you have all the support.
Yes. And elements. Then I've my own team of production. I have 2 assistants and a processor who help me to manage the daily activities of, getting loans from pre-approval to closing.
Yeah. Now, a mortgage officer, can they do some of that themselves, or is that something?
Yeah, you can. It just depends on the volume of business that you're doing. There's a lot of paperwork, a lot of details, a lot of, crossing all the T's and dotting the I's. So if you're doing everything from start to finish, it just limits the capacity that you have and the number of people that you can work with at any time.
I gotcha.
So as you get bigger and you scale, you have to have the people to help.
Just leverage, essentially. Mm-hmm. I gotcha. Now, the processor and the mortgage lender, I often hear them as separate people, but are they always separate people, or is that like it can be the same person?
I mean, technically it could be the same person. There are certain duties that a processor will do that loan officers aren't necessarily allowed to always do. Okay. For example, like I can't be the loan originator and also verify the employment for my borrowers if I'm doing written verifications of employment. There are certain things that they kind of don't want lines to cross, but there's a lot of things now that are automated. So, we can get a verification of employment electronically.
Yeah.
So that doesn't necessarily matter. So,
I see.
Essentially a loan officer could do everything all the way through.
Gotcha. Now, what? Because I mean, obviously there was a lot of hoopla that happened in 2008. Like what? And obviously, I don't know if you want. I don't want to get into the nuts and bolts of all the details, but what are the big things that really changed from how people bought prior to 2008, and then all the changes that got implemented afterwards?
The biggest things have to do with the qualification process and verifying and validating somebody's ability to repay the loan.
Yeah.
In the past, it was really just based on kind of credit score and down payment. They had stated income loans. You just told the loan officer how much money you earned per year.
Interesting.
And it's not always, translating into what you're bringing home.
Yeah.
Or there was people who were fraudulent and told
just
that they made more. Yeah. So,
Yeah.
There was a lot of programs that enabled people to be able to do that and to be able to purchase a lot of homes. And at the time it was fine because you could turn around and sell it for more than what you paid for it. There was loan programs that allowed you to keep your payment super, super low. You never really had to repay that loan over time. But now once the market wasn't increasing, the property values weren't increasing so fast, people kind of had to start paying back the loans. You couldn't sell them and flip them and make a big profit or refinance and take money out of it.
Yeah.
But so now we have much more oversight into how much money does someone really make? Where's their money going? What's their take home pay and what are their other expenses, and really evaluating it from an affordability standpoint of how much you can qualify for. And then the other big piece is the appraisals. Now we have really the appraisal process is different, where there's a lot more regulations, some good and some bad, but more regulation to make sure that the price that you're paying for the house is fair market value, that you're not overpaying, or that it's not just like, hey, I need this house to appraise for $500,000, and that's what you get on the appraisal.
I gotcha.
So in the past, loan officers and appraisers had relationships where they could go, hey, this house is, they want to buy it for $650. Can you appraise it for that? And they would bring an appraisal in.
Interesting.
So it was just a lot more fraud happening and a lot less oversight. And so now there's a lot more checks and balances to make sure that those things aren't happening, that people can repay the loans, and that they're getting fair prices for the houses that they're buying, things like that.
Now people are like, I hear this all the time. People are like, oh, well, I'm going to wait for the market to crash and then I'm going to, scoop up and make a killing, kind of like what happened in 2008.
Mm-hmm.
What is different about what's happening in the market now, as far as you see it, versus what happened back then?
Well, I think a lot of it is really just back to the basics of economic theory of supply and demand.
Yeah.
Back then, there was way more supply of homes and way less demand necessarily in terms of new housing formations, who's buying, starting to get into the housing market.
Yeah.
That's what creates a new buyer, is someone forming a house, getting into the housing market. That's what creates the movement in the market. Because then someone else maybe is selling and moving up to the next house. But there was an oversupply. They had built so many homes, and at the time, people were snatching them up because you could buy them and flip them and sell them quickly, and you would make a big profit. But people were buying way more houses than they needed, not just for their primary residences, but lots of homes.
Yeah.
Now it's kind of the opposite. We had this long period of time where builders were not building new homes. There was not any new inventory coming into the market. And now we have a period of time where we have this new demographic of people, the millennials, who are in that age of forming houses. They're like at peak levels right now, where they're getting into the housing market or wanting to, if they can, but we don't actually have enough inventory coming in to support that.
Yeah.
And so back then, the crash was really, there was just too many homes and not enough people that wanted to live in them.
Mm-hmm.
Now it's going to really the opposite. And so we know that there's a lot of people who are waiting on the sidelines that want to get in. And when mortgage rates come down a little bit, they'll flood into the market and just cause prices to go up, because there's still not enough. There's really not enough inventory for the demand that's out there.
So just for clarity's sake, if the idea is to wait for interest rates to go down so they can afford more house, the consequence of that is that the house that they want to buy at the higher interest rate today may cost more at the lower interest rate.
Right.
And in your view, like, is it more beneficial to just wait to get the lower interest rate, or more beneficial to just get the lower purchase on the price on the property?
Well, home prices have been increasing. Even now, they're not increasing as fast as they did in 2020 and 2021.
Sure.
But if you look at historical appreciation, I think it's somewhere around 4% average appreciation over decades and decades. Right now, last year it was around 4.1%. They're projecting it to be about the same. So if you waited, and instead of buying, say, a $500,000 house today, and you waited 1 year, you now are going to pay $520,000 for that house a year from now. So the house is going to cost more. And if interest rates come down, it will only push up the rate of appreciation. So it's going to cost even more than that if rates get cheaper.
Yeah.
We don't see rates dropping significantly, but if they do fall and you've waited, you still now are paying $20,000 more for that house. That's still going to cause that payment to be higher,
regardless.
Than whatever it would have been today, even depending on how low rates go. But we're not going to see rates go to the 2% and 3% again.
Yeah.
We're expecting like mid sixes by later in this year.
So what's your recommendation then for someone who has that concern? Is the idea then it's better to just try to figure it out now, where the price is a little bit lower, and then?
Well, and right now there are homes that are staying on the market a little bit longer. Mm-hmm. And so there's sellers who are more willing to negotiate with buyers. So buyers have more leverage. They have a little bit more negotiating power.
And you're seeing that. You're seeing that actively in the market.
Absolutely. We're seeing more concessions to help buyers buy their interest rate down, like sellers who are willing to pay a little bit of money towards the buyer's closing costs so that they can get a lower interest rate or not pay as much out of pocket.
Yeah.
So we're definitely seeing sellers that are willing to negotiate for sure on that stuff.
Okay.
And so that's, there's always an opportunity in the future to refinance if rates do come down. But if you waited, then you lost out on all that equity that you could have been building already.
Oh yeah.
Like they say the best time to plant a tree was 30 years ago.
Yeah.
Well, the second best time to plant a tree is today.
Yeah.
Like you can't capture all that equity that you've lost, but if you get into the real estate market now, then you can start growing the equity. And, a lot of people we see, I'm sure you've seen, using the equity that they get in their home to move up to the next one. They buy one, it grows in value, and then later they use that money to put a bigger down payment on the next house as they kind of move up.
Gotcha. Now, is there anything that you're seeing, like trends that you're seeing with regard to like the types of programs that people are using, or, I mean, as it relates to the mortgage industry in general, are there like any, and it could be not only just from the client side, but maybe even from the mortgage side, are there any specific trends that you're seeing that are worth like paying attention to?
Yeah, I mean, generally there's like 4 main loan program types, like FHA, VA, conventional. Those are kind of the biggest things that we see.
Mm-hmm.
But now, and in my career, I've never seen so many other alternatives. I mean, we're looking to see. We have lots of clients that just need to do different types of loans, like a bank statement loan. Instead of using traditional tax returns, we use their bank statements to evaluate the income that they're receiving. Or
now, how is that different than, like, let's say the stated income, the bank statement loan?
So bank statement loan, really, we're analyzing the deposits coming in. Like if you're self-employed, sometimes the tax returns are not always reflective of the most recent time period.
Mm-hmm.
It's also not always reflective of the true income that you're bringing in. There are expenses that you can deduct to help you take advantage of some of the tax deductions that are available.
Sure.
But what that does is it reduces the amount of qualifying income for buying a house. Sometimes when we do bank statement income, we can actually qualify for a larger home because we can see that the money coming in is greater than maybe what your tax returns are reflecting.
I see.
And then it's really on the most recent 12 months period. So, if we were looking back right now, if we pulled somebody's tax return, if they didn't file 2024 yet, we're going all the way back to 2023 and back. to look at what their income was if they're self-employed, whereas the bank statement loan would look at the most recent 12 months and really take in that 2024.
Gotcha. So this is like for like 1099 employees and like business owners, stuff
Absolutely.
like that. I see.
Yeah. So there's a lot of different programs out there. There are programs now for people with stated income where it's literally not stated income, but where they're not actually qualifying on income. It's just based on assets and credit. There are programs for people who are buying investment properties where we're only using what the potential rental income of that property is to qualify. So the property just really has to be able to cover its own expenses. So there's a lot more programs and products out there to help lots of different buyers. And before in my career, I would say in the last 12 months, I've done more of those and had more clients kind of exploring those options than ever before.
Why do you think that is? Why do you think there's so many new like creative loan programs that are in place now?
I think just the needs of buyers, that there are a lot of, everybody's, pay is different. We've got gig employees, we've got 1099 contractors, we've got people working from home or doing multiple jobs. I think that they had to get a little bit more like, there's markets that need to be served by those types of programs. And so, they just are forthcoming because of that. Like there's a need, and so somebody finds a way to fill it.
This is sort of the evolution of where mortgages are kind of leading themselves to.
I'd say the other big thing is down payment assistance. That's one that I'm seeing a lot of right now, that we're doing a lot of right now, because it's just hard. It's hard for people to come up with a big chunk of money for the down payment and closing costs to buy something.
Yeah.
So that's one of the other big things that we're seeing.
Now, one of the things that obviously has changed in the real estate market is the way compensation is done. And I know that sometimes that can impact, mortgage loan, where compensation may have to come from a buyer, for example. How much has that impacted mortgage loans as far as you can tell? I mean, has that been like a really big thing, or has that really been kind of a blip on your radar?
I would say not a really big thing. We're definitely seeing more buyers paying some portion of commissions to seller to their realtors than we had in the past.
Sure.
But I wouldn't say that it's become something that is like cost prohibitive for buyers, where they're now having to come up with thousands and thousands of dollars more. Because most agents have realized how to navigate and how to help the buyers price that into their offers. They're negotiating that in the sales price of the home and still able to have the dollars. Ultimately the buyer was always paying the whole thing. The money is coming from the buyer. That's where it was coming from, even though we said it was the seller that was paying it. But if the buyer wasn't willing to pay that price, then it wasn't going to pay it. So
it's really a concession
really
on behalf
the same
of
thing. So the buyer is now baking that into their price. Like, I can pay this, and that's going to include this cost for my agent and your agent.
Gotcha. Okay.
But yeah, so I think the bigger problem has just been the logistics of it, because there's all these new forms and documents and we don't always get all of them. And so, the seller and the listing agent agree to a certain percentage, and then the buyer and the buyer's agent are agreeing. And then if those don't match, there isn't something always that's telling us who's paying what.
I see.
And so we're just having to kind of make sure to be mindful of it and to ask the questions, is the buyer paying for anything in addition?
Gotcha.
I think there's a lot of probably less experienced or less thorough loan officers that will have clients get to the closing table and not realize it and end up going, oh, well, we only approved you because you only had, X amount of dollars in your bank account, and that's all we thought you needed. But now you need 3% more or $5,000 more because of this buyer broker agreement that you agreed to pay in addition to what the seller would pay. So I think that will happen, because I think that there are a lot of loan officers who aren't detail oriented enough or mindful enough to pay attention to that.
Sure. Interesting.
But
so, in terms of like how, I'm going to switch gears a little bit, because I'm really interested, because I know that the mortgage, there's a tie into like, and I know that it's not, 1-to-1, but there seems to be a relationship between like what the Fed does and then how that impacts mortgage rates. And it seems like sometimes they're not necessarily always in sync, but they're usually kind of similar. So can you just kind of explain a little bit of what that relationship is? Because I know that people hear about that and they're like, well, what does that even mean?
Mm-hmm.
And then mortgage rates are impact. Like, for example, the Fed, back in, I think it was September, they did a big drop. Usually September, October,
Mm-hmm.
but then the mortgage rates didn't follow suit, right?
Yeah, they actually went up after.
Right. They did something that was not people were expecting it to kind of follow suit, and it didn't, right, and whatever. So what is that relationship? Because I think that's hard for a lot of people to understand.
Mm-hmm. Well, what people don't realize is that leading up to that, mortgage rates did fall.
Okay.
Because, mortgage rates, the Fed is giving us indicators of what they think that what they're going to do at each meeting. So we already know, what most of them are predicting for 2025 in terms of how many rate cuts they're going to be.
Yeah.
And so really it's when things change from what they're planning that it throws the market off.
I see.
But that reduction was felt in the mortgage market, but it just had happened before because we already knew that it was happening.
I see.
But the relationship is the Fed funds rate has to do with interbanking rates. It's more for short-term lending.
Yeah.
So it's like credit cards, car payments. It's things like that are more closely affected or directly affected by that rate.
Uh-huh.
Mortgage rates are a longer term investment. And so the biggest driver of mortgage rates and what's going to happen with them is inflation. And so when the Fed goes out and cuts rates, it's really what they say after, what their comments are about where they think the economy is and where things are going that impacts what's going to happen next to mortgage rates.
Yeah.
Because if they feel confident that the economy is slowing and that we're not going to see inflation going up as fast as we did before, that's positive news for mortgage rates. Right now, we've seen mortgage rates kind of up a little bit so far this year. And a lot of that is due to kind of the uncertainty of things like the tariffs that Trump is talking about. Are those tariffs going to cause products to be higher for Americans? And that fear is what, makes us think that there could be some inflation due to that. And that may drive mortgage rates up higher. And the reason for that is because the mortgage money is a fixed amount. It's a fixed payment, right? So if you have a mortgage at an interest rate of 6.8%, you know what that's going to be. And that income from it is the same forever. But your dollar, the income that you're getting, that dollar is now buying less stuff, right?
Right.
So in order for that to be an attractive place for people to want to invest their money, the return has to be greater because my dollar is going to be worth less 10 years from now than it is today.
Right.
So that's why inflation really pushes those mortgage rates up. And so as the Fed is cutting rates, they're kind of trying to help stimulate the economy again, right?
I see.
But the economy has still been strong. It stayed strong. And so far, the jobs reports are still coming in higher than they expected them to be. And so there's just that fear that inflation is going to continue until we really get it under control.
Gotcha.
Which is really when we'll see mortgage rates come down.
Do you have any thoughts on where, obviously we're not economists. We're just, we have our businesses that we're running and operating and stuff like that. But do you have any thoughts on like where you think that might go?
In 22 years in this business, I still feel like it takes a crystal ball to be able to see what's going to happen because there's so much that goes into it. So many unexpected things, what happens in economies across the globe impacts our dollar and impacts those things. So there's just too much uncertainty. I do feel that interest rates are going to come down. I think it's going to be a gradual reduction. And I think that hopefully by the end of the year, we'll see them closer to the low sixes, maybe even into the fives.
Okay.
They're predicting that that's probably where we should end up by next year.
That'd be interesting.
Like the high fives.
Yeah, that'd be great.
But we know for every, I think it's a percentage drop in mortgage rates, like millions more people are entering the market. So, then we'll see prices increase. It's just, it's interesting. I think now we're kind of in this uncertain time with a new presidency and a lot of changes obviously going on in the government. I think that's, whatever side of the aisle you're on that, I think you can't argue that it's just change.
Yeah.
And so like when there's change, it creates volatility and uncertainty.
For sure. Yeah. And it'll probably be some time before we actually see the results of that to even know like, okay, was that even a good call? Was that a bad call?
Yeah.
Like,
are things better or worse than when we started? Really, it's
really
what we're all hoping for. Better, of course.
Yeah.
But you just never know what the ramifications are going to be of all those things that they're doing. So.
Yeah, and I think that there are some, there's certainly arguments on both sides. When you hear some of the well thought out arguments on both sides, you can understand like where they're coming from.
Mm-hmm.
I don't know that I am educated enough in the nuance to be able to like discern which has the better argument.
Mm-hmm.
I mean, I have gut feelings about things, but I don't know that I'm qualified to have those conversations. Right. So I'm kind of in a wait and see kind of position, because I mean, there's not really much else we can do at this stage. So it's going to be interesting to see how that turns out.
Yeah.
So
yeah, it's just too hard to predict. I think now, instead of ever gambling with mortgage rates, I really encourage people like, let's take a look at where we are today.
Yeah.
We don't know what's going to happen tomorrow.
Sure.
Things could literally go in either direction for a number of reasons. So where are we today? Where can we go that's going to like help you to be comfortable with what mortgage payment that you have?
Yeah.
I know that one of the big words or whatever you heard a while ago was marry the house and date the rate.
Oh yeah.
And like that was this mantra people had, which is cute. And you're right. Like, find a home that you love and worry about the rate later. Sounds great. Or you can refinance down the road. You're not tied to this for forever. But at the same time, you still have to pay the mortgage until then.
Still scary.
And so we don't know if rates are going to come down low enough to where it makes sense for people to refinance. Sure. So I never want anybody to go into a home thinking like, oh, well, it's going to be really hard for me to make this payment for the next 24 months, but then I'll refinance and I'll save hundreds of dollars.
Yeah, that'd be fine, right?
Yeah, that's not really what you should ever count on.
Yeah.
So I think like just looking at where are we now? Do I need to buy a house? Do I want to buy a house? Have I outgrown this one? Like that's really what I think people should be really focusing on instead of trying to time the market, because it's like,
well, no one can.
It's like trying to time crypto. You want to buy at the lowest and sell at the highest, but you can't tell until it's passed.
That's true. And what's funny is that, and I've had people on the investment side, on the obviously when I was selling homes, talk to me about, oh well, I'm waiting for the market to shift or change, and so I can time it right. And I'm like, so I just want to make sure that you understand.
Right.
I've been in this business for the last 5 years, and I know people that have been in the business for 20, 30, 40 years. I guarantee you, if there was a way to be able to predict that game, like these guys would be bazillionaires.
I'd be on a private jet somewhere. I mean, in 22 years, I should have been able to figure that out at some point.
But that's not how it works. Like, there's no way to truly predict that.
No.
So, for someone to come in and kind of their mentality is, oh well, I'm gonna time it right. Mm-hmm. Like no one's been able to really time it right. So I'm sure there are people that can kind of anticipate when things are going to happen, and eventually when things kind of position themselves, they can make a move. But usually those are people that are high net worth people. Right. They have the means to be able to wait or go, or they can just kind of move on. They can
take advantage of those opportunities when they arise quickly.
The average American is not in that position to do that.
Right.
So, it's really, you hit the nail on the head when it's really about like, we live right now.
Yeah.
That's what we can only make decisions like that affect like our current circumstances. Mm-hmm. Like there's no way for us to really predict the future. You can do things to kind of anticipate for things, but if you're going to move on something, it seems like it makes the most sense to kind of identify, well, what can I do right now that would make the most sense for me right now based on my circumstances?
Yeah, absolutely.
And I know you deal with residential mortgages, so the average person who moves typically moves because they have to. Like when they buy something, they buy or sell. Typically, there's some life event or something that's usually related to that, right?
They're starting a family.
Yeah,
or,
there's a
lot
new
of people
child.
downsizing.
Yeah, exactly.
Mm-hmm.
So, like, really, their circumstances are dictating kind of their move in the first place.
Yeah,
and whether or not like that is the thing. Like, is it a good time for me to move? And trying to time the market is not usually the reason why people move.
No.
Mm-mm. People move because they're in their life circumstances have put them in a position where, hey, moving makes sense right now.
Right.
And they got to really think about that.
Yep, absolutely.
So I definitely would agree with that.
Yeah, I think just sometimes people get in a little like it too over their heads in thinking of all of these things. Like they don't want to miss out on this lower interest rate or those things. But really at the end of the day, it's about the house that you live in. It's about the home. You know, for some it's investors. Investors are different.
That's different.
Then we're looking at return on investment and we're looking at that kind of stuff. But from a standpoint of where you're going to live, it's just like where you want your kids to go to school or where you want to retire, and are you ready to stop shoveling snow in Pennsylvania and move to Florida? Like those are the things that are driving people to make those choices. And so that's really what's most important. The mortgage is really only the vehicle to get you there.
You know, what's interesting is that, you know, there's also, and I feel like younger generations are I guess, you know, that's not true. I think all generations have probably done this. Like, you know, I've been hearing from a lot of the agents that are in my program when they're talking with people that they're looking for like their forever home. And this is the first home they're buying.
Yeah.
And they're like, oh, well, we can't afford our forever home, so we just won't buy a house. And not realizing that, well, you know, you're not obligated to buy your forever home. Buy the home that you can afford now, build some equity, and then 5 years down the line, 7 years down the line, and upgrade, right?
Right.
Like that, you have all
That's
this.
That's like the house hack.
Yeah.
That's like the best house hack ever.
Yeah.
Because then you're, instead of having to save up all that money
to buy
that bigger one, you're saving automatically while you're living there.
Yeah.
And you're paying the mortgage down. So your equity is growing double.
Right.
But I feel like HGTV did that to us all.
Oh, try. Yes, true.
Like
I can see
when
that.
HGTV came out and started showing us all of these beautiful homes and dream homes, like we stopped having the imagination, I guess, or we all want the perfect dream home. But I know my first house was built in 1972 or something, with linoleum floor and like this sunken dining room that looked like a little carousel around the outside. It was terrible. And when we first bought it, we thought we're going to tear this all up immediately and you know, make it beautiful. It took us a while, but once we moved in, we realized those things didn't really matter to us. Once you put your furniture in, and it was a great home. We eventually renovated it and then moved. So, you know, but we took a ton of equity from that home and we're able to go up to move into the next one. And I see a lot of people doing that. But you're right. I see a lot of other people who can't imagine buying something that's not their perfect dream home.
And I mean, I think a lot of that has to do, I feel like a lot of that has to do with, social media has had a huge impact, I think, on civilization in general. And I think it changes people's expectations of both themselves and then of others, right? Because all you see is like, it's the curated, beautiful life of a person.
Right.
And you don't realize that person has all kinds of like travesties and tragedies they're dealing with, and they're a hot mess. But on social media, they look like they're like killing it, right? So, you know, when going to this HDTV idea, like you see all that with other people that are also online. And then, you know, when someone wants to buy a house, sometimes I think they feel like they have to keep up with the Joneses.
Right.
And they're like, well, I don't want to buy that because then how are people going to see me in this house? Not realizing that, well, who cares?
Yeah.
Nobody cares.
And really, I can't ever think of like a home I would ever have walked into and been like, oh, your kitchen is really old.
Yeah.
You know, like, you don't think that when you're going to visit a friend for dinner. That's not what you're looking at. And if you are, then you're bringing the wrong friends over for dinner.
Right, exactly.
So, but yeah, you know, I mean, just make it your own. And there's ways to do things. There's ways to do renovations and things less expensively, or you do it over time as you can.
And I think that's an important feature of home ownership, is that because you live there, I mean, you have as much time as you live there to update and upgrade as you go. And then you can do some yourself, or if you want to hire some of that stuff yourself. I mean, whatever, you got options.
Right. Well, a lot of people are using the equity that they've gained in their homes to do it. So it's not even like they're having to save up to do those renovations. They've got equity that's grown in their home over the time of owning it because the values have gone up, and now they can actually tap into a little bit of that equity and use it to do renovations.
Yeah, I can see that.
We've had more and more people calling us for that, home equity lines for that kind of stuff too, that, you know, maybe they don't want to move yet, or they do want to move and they know that in order to get the best value for their home, they need to fix it up a little bit before they sell.
Yeah.
And so those are options that people can tap into. But otherwise, if you don't own a home and you're just renting, you're still just paying rent and having to come up with those savings.
Oh, for sure. Can you, now that you mentioned home equity lines, I think there's a lot of people don't understand how they work, because, oftentimes I'll hear, and I think it sounds like different banks treat them differently, where some banks, when you pull a home equity line, you have to pay on it right away. And some banks, when you pull a home equity line, you don't pay on it until you start using it. So can you just give sort of the layman's version of what a home equity line of credit is and how that impacts a person, and how is that different than like just a regular mortgage or refinancing?
Yeah. Well, I think a lot of people don't actually understand what equity means.
Okay.
So because I get that question a lot, like, where does the money come from? Well, when you buy a house, if you pay $300,000 for that house and you borrow $250,000 for it, you start with $50,000 of equity in that home. That's value that if you sold it, you would be able to take out, right? So now that $300,000 home goes to $400,000 over time of owning the home. Now the equity that you have is $150,000. So if you sold it, aside from the costs, you have $150,000 that you would take out. And so a home equity line is where they allow you a line of credit tied to that home to be able to take some of that equity out in advance of selling it. And so it's a loan that people get, but you're right. There's totally all different kinds of them. A traditional home equity line of credit, I always think of as a line of credit, like a credit card almost, that's tied to your home with a limit on it. And you only pay on what you need. So you draw a little bit out from it, and then you're paying interest on that amount or repaying the balance of it. You draw more, you're paying interest on that. That's what I would think of as a traditional home equity line of credit.
Okay.
But like we have a program that is the opposite one that you mentioned, where we give the full amount at the time of closing on it, and then you start making payments, principal and interest payments, to repay that loan over a period of time that you've decided. And so it's just different structures. So when someone comes to me and tells me that they're interested in that, what I always want to find out is, what are our plans for the money?
Yeah.
Like if you're going to do home renovations and you want to, do some things over time and do it yourself, then the traditional kind that you just take a little bit out as you need it, as you go, and you only pay that back as you go and, do it.
Yeah.
That's the better product for you.
Yeah.
If you tell me that I've got credit card debt of $50,000 and I want to pay that all off, then we want to give you all of the money up front, and then we're going to put you in a payment plan that's going to repay the principal and interest of that back over the period of time that so debt consolidation would be the other type. So just depends on really what people's needs are and goals are on which program will be the best for them.
I see.
But I think that's one of the reasons why it's super important to have somebody that you can talk to that's an expert in mortgages, rather than, a lot of people just go online and do online applications and things like that. And
or they'll go to I also hear a lot of people go to like their personal bank.
Yep.
Which I always try to dissuade people to do.
Well, banks are usually the main source for home equity lines.
Yeah.
But banks are banks. And their main source of business is the checking, the deposits, the savings. That's their thing. A lot of times they just do equity lines because their clients need it. It's kind of another way to build that relationship with their client. And so not all of them are great. Not all of them have great terms. But there are some that out there that offer good terms. And so it's important to know and to shop around even more than a regular traditional mortgage, a home equity line, because they're so different.
Yeah. I've heard about different. Like I was talking to, I don't remember who it was. It was a previous client of mine, and they were saying they were getting a home equity line, and they were talking with a bank, and that the bank said that the only option they had was the non-traditional one, where they pull the whole amount and then they pay every month, and that's what they were concerned about. And they were like, oh well, I don't want to have to pay all of it up front.
Right.
So I was like, that sounds weird. I'm not familiar with that, but I'm not an expert. So I was like, well, you should talk to, and I got them connected with a mortgage lender to kind of have that conversation. I may have sent them to you. I don't remember who I sent it. This is probably like a year ago.
Possibly, yeah.
But it was surprising to me, because I was like, oh, there are other options for people. And like you said, depending on what their needs are, that option may work. Right. And I didn't know what his needs were. So I didn't want to talk to him about that, because that's not my area of specialization. So it was just interesting to hear that there's so many options. And you're right. Based on what you said earlier, is I feel like every time you come in to talk to us and in our meetings and stuff like that, there's like some new thing that you're like, hey, and by the way, there's this other thing that we have access to. I'm like, oh my, it's another new thing.
It's a lot to keep track of, that's for sure.
Yeah. So that's kind of cool that it seems like there's like an evolution of what's happening, which is interesting.
Yeah.
So how much do you pay attention to like just sort of local economics? Do you pay attention to any of that stuff at all? Is that something that you mean, like, you have any thoughts on it at all?
Like Claremont or just Florida?
Just Central Florida, I guess just Central Florida.
I mean, I certainly follow the economy and listen to economic advisors and predictors about things that are going on. I think that we're in an economy in Florida that is continuing to thrive and grow.
Yeah.
And certainly people are moving here every single day from other parts of the country, over the place.
Yeah.
So I think that even in other parts of the country, we may see a little bit of a softer market, I guess, than in Florida. I think ours will stay strong just because it's cold everywhere else. People want to come here, and there's a lot of politics people come here for. There's a lot of weather people come here for. Just a lot of reasons to bring people here. So I think that our economy should stay strong and maybe even stronger than other parts of the country.
Yeah, I think so too. I feel like, we're positioned pretty well. Obviously we have the weather, which is why a lot of people come. People come because of the parks.
Right.
We have a lot of retarees that are coming here.
The Villages is
continuing.
Enormous.
Yeah.
And all around it.
Yeah, exactly.
Everywhere. People are looking for that lifestyle.
So it's really interesting. And there's some specific industries that are really kind of picking up right now. And we're seeing a lot of the tech industry, for example, is starting to pick up locally. And what's happening on Space Coast, we're seeing a lot of aerospace and advanced manufacturing that's starting to build up. So
I can see that.
And then, of course, because we have all the retirees, we have the healthcare industry that is
obviously booming here.
Yeah,
everywhere we go, there's new medical stuff.
So there's just a lot that's happening here that seems to, I feel like it's like we're going to be shielded, but I always like to ask other people to kind of see, like, because sometimes I feel like, am I being overly optimistic? Because I'm an optimistic person, and sometimes that can blind me to shortfalls, shortcomings.
I am also a glass is half full kind of person.
So I like to ask other people just in case. I'm like, maybe I want to make sure I'm not missing something. So I'm like, but so far everyone I've talked to seems to be feeling the same way. So I feel like, even if the rest of the other areas of the United States might, like you said, have a bit of a softer, market in general, that we're going to be shielded from a lot of that stuff just because there's so much happening, I think, in Central Florida. So it's going to be interesting to see how that ultimately plays out.
Yeah. Well, and I think like our areas, like even more in a smaller scale, the Lake County, Claremont area, there's so much growth here because there was so much room for growth. You know? I mean, there's a lot of places. I grew up in South Florida, and there's nowhere else to go. There's nowhere else to build.
Right.
In order to build something new, you're knocking something else down. There's not a lot of expansion down there.
Yeah.
There's a ton of wealth that keeps moving there, and it's kind of pushing other people out. But here in Claremont, there was a lot of area, and there still is. Just you can see by every neighborhood that you can see where once were trees are now a cleared out plot of land that will be a housing development. And so with that comes all the businesses that need to come, and it comes the jobs and the schools. And so all of those things are just driving the growth in our area, and it will continue that way for quite a while. Because,
it's interesting. So, I specialize in commercial. So one of the things that I'm having really a difficult time with is finding properties in the sort of greater Claremont area available for clients that want to like buy assets here. Like there's not a lot of options. Like there's a couple things that you can maybe build.
Yeah.
But like, there's not really anything that is available.
Like an old vacant building.
No, it's so hard. It's really difficult to find like property here. Like there's more stuff if you go towards Orlando or you go up towards Leesburg and stuff like that. But like, I mean, it's a really tight market.
I can see that. And everything that is coming in is all new construction.
Yes.
Which is obviously really a big cost to get in.
Yeah, exactly. You have to have big pockets to do some of those projects. Yeah. So because they're not small projects, it's like, oh, well, there's 5 acres here that you can build on. Go ahead and buy the whole 5 acres.
Right.
Like, that's a lot to build on.
Yeah.
So, it requires sort of bigger players, and most of the local business owners and stuff like that, they don't have, they're not in a position to do stuff, and nor would they, they're not really interested.
Necessarily support that type of thing.
That's not really a thing that would work for their business anyways. So it's really interesting to see that, because then you go to like Orlando, for example. Orlando has a lot of inventory. There's a lot of stuff to choose from and stuff like that. So it seems like the secondary and tertiary markets are getting really tight, and then the primary market, which was Orlando, has sort of gotten has softened substantially. So you could probably buy something pretty decently priced in Orlando, where in like Claremont would be very, very difficult.
That's interesting.
And the pricing is even reflective of that. So like before, if you want to buy something in Orlando, you're paying a premium for that.
Yeah.
Now it's not.
It's back to supply and demand again, because there's so much supply, and that they have to drop the price in order to compete.
So like the pricing is almost on par. So if you want to buy something in the middle of Orlando, or if you wanted to buy something in, let's say, Claremont, like the pricing is pretty close.
Wow, that's interesting.
You know what I'm saying? And then you're talking about like the center of the city of Orlando versus like 40 minutes away.
Yeah, that's exactly a big difference.
Yeah. So, and it used to be there was sort of a gap. There's definitely a gap there. So it's been interesting to see like how the market is behaving. Specifically in sort of the we're in a secondary market, right? Sort of like an outskirt of a main market, which is Orlando, and it's been interesting to see the dynamics of that, because when I get people or investors that are calling from out of state or from out of the area, and they want to get into a secondary market because they think they're going to get a better deal, and I'm telling them where the prices are, and I'm telling them like, hey, this is what you can expect, and they're like, but wait a minute, how there's something in Orlando I can get for that price,
right?
And like, yeah, you can.
Yeah, if you want to drive there every day,
you're right.
Fine. It's up to you.
Pick your poison, right?
Exactly.
So it's been interesting to see that, and I know that commercial tends to follow residential. So it sounds to me like, at least from the beginning of this quarter, there's been a bit of a pickup in activity. Have you seen that? Is that something that you're seeing?
Yeah, absolutely. So, I mean, even actually nationwide with our company, we've seen more applications up, but we've noticed it locally for sure. A lot more volume, a lot more activity. People
are just wanting to look more and get pre-approved and that kind of thing. Are you
I think people are kind of coming to terms also with the rates of where they are.
Sure.
It was really hard to go from 3 to 6, and people are or 7 and even 8. We were up close to 8 at some points. And so that's really hard pill to swallow.
Yeah.
I think now that it's been some time, our memories are short. And so, now we realize like the 6 to 7 range is kind of a normal range now.
Yeah.
We're not expecting 3 at this point.
Yeah.
So I think more people are willing to take that leap, but
sure,
it's a big jump. I mean, I was just talking to someone this week who has outgrown her home. She has another baby, they've just outgrown it, and they want to buy something new. They've got a lot of equity, but their rate's 2%, and she just can't wrap her mind around increasing her mortgage payment so much for the next house. And that's, that jump is so much bigger when the move up than it was before.
Sure.
But, there's a lot of people who are staying in homes longer that they necessarily don't fit for them, or they don't want anymore because they're not willing to give it up. And it's like, a lot of it is psychological. Just the idea of a payment going up from, say, $1,800 to $3,500. I mean, that's a big jump.
Sure. Especially if the house is not that much of a difference in size.
Yeah, true.
So, usually there's an anticipation of like, oh, well, I'm getting a bigger house, so there will be a little bit of bigger payment. But I could totally understand her position. Like, hey, I'm paying so little now, and then if I go and I get this new mortgage, it'll be so much more versus what I was paying. But then it kind of boils down to like, well, what do you need?
Right. What's most important to you?
So, something that kind of came up, it was someone who was teaching this. It's called portability. Yeah, so that's becoming a really popular. Apparently, it's been around for a long time.
Yes, it has. It's definitely been a thing.
Yeah, so it was interesting to hear that you can port your homesteaded home taxes into your new home, which I mean I would imagine could potentially have a huge impact in the affordability that you have, because now your mortgage is going to be smaller because your taxes are less.
Right.
So like, have you seen a lot of like people leveraging portability? And
absolutely. And I think that a lot of people probably don't factor that in when they're thinking about that next home. But it's basically taking the equity that you have built over time and applying it to the next property so that your taxes stay lower. And it was meant for people like my parents, for example. They bought their home back in 1980 for $170,000, and it's down in South Florida on the water. So now that home is worth much, much more.
Yeah.
Over a couple $1 million.
Oh, wow.
But over time, had they been taxed on what the value of that home was appreciating to, they wouldn't have been able to afford it.
Oh, for sure.
Because it would price people out of their homes.
Absolutely.
So that's what that was intended to do, was protect people and keep them from being priced out of their homes because of home values.
Yeah.
So it locks in your value, and then the equity that you gain, you can move over, because now if you can't move it, now you're stuck in that home forever. Because when you move, your taxes are going to go up. So it allows you to carry that to the next property, and in many cases can apply a big amount, especially for anyone who bought in, say, 2020, 2019, 2021. We saw a lot of appreciation after that in homes.
For sure.
Like, if you bought in 2023 to 2024, it's not going to be a big amount if you go to move over. But if you bought and now your home is worth much more, you will be able to take that extra equity and apply it to the next house.
Which is something to like that. I think for a good agent and a good mortgage broker, that level of sophistication is helpful, because it allows a conversation to be had about, I'm concerned about this 6% and what my monthly payment's going to be. And then be able to say, well, actually, if we are able to port over the taxes that you currently pay here, your payment actually won't be this much. It'll be some smaller amount. Right now, you're helping to,
you're buying a $600,000 house now. Now you're not going to have to pay $8,000 in taxes for it, because you're only going to be taxed on a $500,000 or $400,000 house, because you've got all this equity that you brought from the last
which
one.
is awesome. So like I think that and that's literally like that translates oftentimes, especially when you're talking about those kinds of differences, into thousands of dollars a year.
Yeah, it absolutely can.
So that can definitely impact like what your mortgage payment is going to be, especially because everything usually gets tied up in escrow and everything.
Yep.
So like what you're ultimately paying ends up being much more reasonable than what you would have paid if you didn't do that ported taxes. So
exactly.
And I know that's a whole other topic to get into, which I'm not going to get into with you as it relates to portability. But it's just it was interesting to learn about that, and then to find out that that's actually been around for. So I think it came around 2008. I think when it came.
Yeah, when they applied that portability.
Yeah, I think that's around that time.
That's about right.
So so it was just interesting to see that. Okay, so there's as they say, which is a terrible saying, there's more than one way to skin a cat.
Right.
Which is the worst thing
Such a gross thing.
I don't know where they came from.
I don't know either.
But I guess there is.
Are there really?
I don't know. I don't know.
I don't want to think about it.
But it's just there's a more than one way to kind of look at things, which is really cool to kind of think about. Like, not only are there different programs, but there are also these different nuances of how you can leverage either your current living situation, right? And then down payment assistance and all this other stuff, which is really cool.
Yeah, I think, again, why it's super important to talk with somebody who's an expert, an experienced person, and things like that. It's the biggest purchase of your life, most people buying a home.
Yeah.
And so talking with somebody who can actually sit down and look at all of those things with you is super important as a real estate agent and as a mortgage lender. I think too many people are only focused on like the best rate and the lowest cost. And there's a cost for that, just like anything else, there's a cost. If you want to work with somebody who's an expert, you may need to, the cost really shouldn't be much. Like, it's not like we're charging more, but I think the focus isn't always in the right place. Like, the focus should be on who is going to give you the best advice and information to help you accomplish your goals, not always just on who's going to give the best rate, but the rates should all be comparable anyway.
Well, I mean, I think this goes into this idea of cost versus value, right? Like, I think that people get caught up, like you said, in cost and not really paying attention to value.
Right.
And,
they're doing all other things though. Like there's a reason they stay at a Hilton and not a Motel 8.
That's true.
Or they drive an Acura and not a Yugo. I don't know what kind of car to compare to, but like there's a reason people make those choices.
Sure.
They do in all other things, but it's for sometimes in the mortgage that kind of gets lost.
Well, I mean, the same thing with real estate, right? Is like just in general, I think for everything related to real estate, there's always sort of this thought of the cost and not really taking into consideration the value.
Right.
Right. And this is one of the reasons why when I was selling homes, I would really want to get an understanding of like the lifestyle they were looking for.
Right.
Because you can find the house that you want for the price that you want. It just may not be in the place that you want.
Right.
So if it's not in the right place, then yes, you got the cost, but are you getting the value that you want?
Right.
Like you may have to live out in the sticks or.
Yeah. Now you're spending all of your time on driving to and from work and all your money on gas and tolls.
And everything's inconvenient. And it's just not like you can't live the lifestyle you want because you like shopping, and you're not close to shopping or whatever the case may be. Right. So like, okay, great. You got the cost that you want, but are you getting the value for what you paid for it? And I think that is the better way to just look at the things that you are willing, that you're going to be investing your money and time in, is like, what is the value that I'm getting out of this?
Right.
And I think that's where what you're talking about before is like taking the time to identify who is going to be the expert that's going to help you navigate this,
right,
so that you get the value out of it. And then in that you'll get an idea of what the cost is, but then when you apply value to it, then the cost becomes less important because of the return that you're getting, and that return is the value, right? So I think that the mindset for those things is important. And that's interesting that you mentioned that. Like, why is it that people are willing to pay for the value of a Mercedes, over a Toyota or a Ford, but like when it comes to something as important as like the home they're going to live in, that's where they want to cut corners,
right?
That does seem odd.
I mean, it's big. The money is bigger. The proportions are large, but it is an interesting. I think from the mortgage side, we've been somewhat commoditized down to, and I think a lot of mortgage lenders have done it to themselves and just trying to promote, I have the lowest rates or the lowest costs. And you know what? You could put 10 mortgage lenders in the same room, and really our rates and costs are going to be comparable and about the same. Now, one day one might be slightly lower, one day one might be, but really realistically, the market is coming from, all the money's coming from the same place ultimately.
It's the same pool.
So really, but just like anything else, there's always going to be somebody who's willing to do it cheaper.
Sure.
But what are you giving up for that?
Well, I think this goes back also to like, if you're just focused on cost and not necessarily on value, so that means you don't necessarily want to work with the expert, right? Because let's say, whatever you're presenting is a half a point more than the other person because they're cutting whatever their fees are, whatever the case may be, right? Because they're just trying to get the business, right? While you're really trying to help somebody. Well, what they will miss from that conversation might be the conversation about portability,
right?
Or it might be the conversation about down payment assistance, or, oh, you know what, if we structure it this way, then if we use this loan program, you might actually be better off doing it this way versus that way, right?
Or if we, instead of putting all this money down, maybe we pay off these 3 things on your credit card, and now your cash flow is better, where you can afford this home better and be more comfortable without struggling to pay these other bills too.
Correct, right? Where the cost person is probably going to be like, sure, I'll sign you up. This is what you could afford.
Right. That's lowest payment, lowest rate. There you go. And that's fine. But you've got to look at it holistically at the whole thing and see what's going to be the best for growth. If, net worth is your biggest goal, if lowest monthly payment, if lowest, what is your goal and why are we doing it to help find the right avenue to get there.
That's awesome. So I want to totally be respectful of your time. So I just kind of want to wrap things up. I want to end on this because I think talking about expertise is really important. If anyone has any questions about mortgages or lending, home equity lines of credit, or just anything like that, where can people find you?
Well, they can find me online at mylenderjen.com.
MyLenderJen.
MyLenderJen.com.
Okay.
Or can call me on my phone. I've got my local number is 407-203-7153. I'm always happy to give people some information and to help educate. So, there's oftentimes people will call me and ask for information, or realtors will refer clients to me and say, hey, can you talk to these clients? They're not sure if they need a mortgage or this is what they're trying to do. And there's times where I'll just say, listen, you don't need me. Here's the best way, or this is the best product or program for you. You should call your bank and, get an equity line on the home in New York you're trying to sell and then pay cash here. And so I'm always going to give people advice from a standpoint of what's best for them. I'm not a salesperson. So.
Sure. And that's important, because I think that a lot of people assume that when they sit with you that they're committing something.
Right.
Like, this means I'm going to be signing up or applying. And and really the consultation is just to kind of get a better understanding of where they are and then what you think is the best.
I think a lot of people are afraid also to hear, like if they want to buy a house, I think they're afraid to hear that they can't. No. They're afraid to hear that their credit's not good, or they're afraid to hear that they just can't make it happen.
Sure.
And so that stops them from ever talking to anyone. But, one of the things that we do a lot of times is just give people a plan and a pathway. You want to buy a house, whether it's in this year or ever.
Yeah.
Here's the path to get there.
Yeah.
This is what you need to do to put the things in place to help you get there.
Yeah.
And we do a lot of that. And it's, it's important for people to have a map to know where to go. Otherwise, you're just, a lot of times people do all the wrong things.
Yeah.
And years later, we're still in the same boat and you still can't buy a house.
What's interesting about that, and I know that I'm here trying to wrap things up.
That's okay.
But, one of the things that I like about that is that, and I learned this from you doing this with some of my clients when I was selling homes, is that most people will come and say, oh, well, I have all this debt I got to take care of, and I'm just going to pay all this debt down. And then when I pay this debt down, then I'll be in a better position. And then, I would send them and say, well, just chat with Jen and her team and just see what they tell you. And then you would kind of look at their situation. And I remember, I don't remember who it was, but you've done this with a couple of my previous clients. And you said to them, well, you actually don't need to pay all of this down. You need to pay these 3 things down. And if you pay these 3 things down, still pay this, but this is what you got to get rid of over here. You get rid of this, and then we're going to be able to really do some major things. Right. And that changed the game for them, because then they realized that instead of having to pay this entirety of a debt that they owed, that you had them focus on a few key elements. And once they were able to pay that off, they were in a position to be able to actually afford a mortgage and move forward. So sometimes I think people also think that the only way to solve the debt that they're in and buy a home is they have to pay it all off before they do that. Yeah. Not realizing that really as a mortgage lender, there are certain key things that they need to take care of. Versus, and I think for that one I think she had student debt, and there's all kinds of other stuff that I know from your side of it, it's counted differently. Right. So, so that was a big game changer for me, my mindset at the time, to realize, it's not just about paying down debt. It's paying down the right debt in order to position them in, to be able to make the next move. Yeah. Everybody's situation is different. But one of the big mistakes a lot of people make is, my lease is up next month, I got to move. And then they start. Well, if we only have 30 days, that can be difficult to make the kinds of moves and changes that we need to. But it can be something as simple as, hey, there was this old medical collection on your credit report. If you can call and get that paid up, settled, whatever, that will come off your credit report and your score will go from a 660 to a 740. And that's going to make a big difference in what buying power you have, what interest rates you get, the programs that are available to you. And so if we only have 3 weeks to do it before you close because you already are under contract on something, that's a lot different than, hey, we talked to somebody 6 months before we were really ready to buy. Gotcha. And now we're in a position where we're going to get the best mortgage with the best interest rates available for us today. Not just what we can get. Right. It really requires a pre-planning to really make sure that everything's good. I mean, I think also the other thing is that sometimes, and this has only happened, I think once, someone, they had a pre-qualification with someone, but it wasn't fully vetted. And then when they went to actually go to closing, they found out in there that their credit had been hacked or something like that. And they were not able to close because they had to, that was a problem. Their identity had gotten stolen. Right. And there was a bunch of, stuff that was on their credit report that wasn't theirs. Yeah. And, the whoever did the pre-qual didn't do any of the vetting, and then now they are not able to close. Right. Now they spent money on an inspection and an appraisal. Right. And they're in the middle of a deal. That money's gone. And they can't even buy now because they got to fix that problem. So they were like out for like another year or two to try to fix all of those problems. So like, I think just having that conversation is also good, just from understanding what's going on with my finances. Because sometimes you don't even realize that something like that's even happening. Absolutely. Until you do that kind of research. And the last place you want to be doing that is at the closing table. Absolutely. It's super expensive and really uncomfortable. Yeah, that's a terrible time. Yeah. So that's another thing too, is also just, and again, it doesn't happen often, but it certainly can happen. And knowing that in advance, then you can say, oh my goodness, we got to take care of this because this is going to prevent us from moving forward. Yeah. So I think that's another reason to sort of have those conversations as early as possible, even though they're not necessarily ready to move right now. So absolutely. Anyways, I'm going to sit here and talk to you forever. So I really appreciate you coming out. Thank you so much. So this has been Jen from Movement Mortgage. My name is Gus. I appreciate you guys watching here at the Ortiz Anomaly podcast. If you guys like what you're hearing, please make sure that you comment. If you have any questions, leave them in the comments below. Obviously, feel free to reach out to Jen anytime with regard to mortgage lending or home equity lines of credit, or just questions about what opportunities that may exist for you. If you're wanting to just talk about that, we're here for you. Whatever you want. If you have any particular topics that you want to learn about, please make sure you let us know, and I'll go ahead and try to find someone to talk to about that, and we'll have a conversation. So thank you for your time. I appreciate you. Please please share, please comment. See you next time. Peace. All right. Cool. Thank you, man.